Hey everyone! Today I want to walk through the process of purchasing a call option and comparing some of the different choices we have. Here I have pulled up Southwest Airlines. I currently have two option chains open, the options that expire in 7 days and the September options that expire in 112 days. Looking at the Greeks, we can see that theta is quite a lot higher in the options that expire next week versus 4 months from now. This is because options expiring next week are running out of time and have seriously accelerated time decay. Now let's turn our attention to gamma, which is also much higher in the options that expire next week. This is key, because if the option moves in our favor, our deltas will increase rapidly, and with that, so will our profits. Keep in mind, this is a trade-off. Our profits can be much higher with the short-term option if we're right about direction. But if we're wrong, there's very little room for error, and our entire investment could be gone very quickly. With that, let's go ahead and make a trade. For this example, I'm going to take a gamble on the shorter-term option that expires next week. Chances are I'll lose this entire investment, but if I get lucky, maybe I can make a substantial return. If I choose an in-the-money option, the further in the money I go, the higher probability of success, but a smaller return on capital. If I select an option that's out of the money, the further out I go, the lower my probability of success, but the greater potential return on capital. I'm going to select this 61 strike price call. It's 35 cents out of the money, and because I have to buy on the ask, it's going to cost me 55 cents. Now, I could put in a bid for less and hope for a fill. But for this example, let's just pay the ask price of 55 cents. To break even on this trade, the stock not only has to reach 61, but it then has to trade up another 55 cents. So my break even is $61.55. In order to execute this trade, all I have to do is left-click on the ask price of 55 cents, and Thinkorswim will add the option to my order entry box at the bottom. I want to leave it on 10 contracts, but if I wanted to, I could change the quantity to any number I desired by clicking the drop-down arrow or using the plus and minus buttons here. I'll stick with 10. Everything looks good, so I can hit the Confirm and Send button. I will then be presented with some basic details about the trade before it actually sends. My break-even of $61.55, like we just calculated, is listed. Next, we see my max profit, which comes in at an impressive infinite. That's due to the fact that technically there is no limit to how high a stock can go. For this reason, all call options have infinite profit potential, just like all stocks have infinite profit potential. I also get my max loss, which is no surprise, is $550, because I paid 55 cents times the 1,000 shares the 10 contracts control. When buying options, we also can't lose more than what the option cost. If the option goes to zero, then I lose my full $550, which is a worst-case scenario. So our max loss when buying options is always what we pay for the position. We see the fee that TD Ameritrade charges for the trade and the total buying power effect on this account. Because I am tying up $550 in capital and paying a commission of $13.45, the result of my buying power is going to be $563.45. If I end up selling this trade back out before it expires, whatever I get for that sale will go back into my buying power, less any commissions I pay to take the trade off. After looking at this trade, I think I am having second thoughts about putting it on. If I go back to the option chain and take a look at the 61 strike, I see this call has a delta of 0.43. which translates into a 43% probability of this call finishing in the money. If I don't like converting the delta into a percentage, I can always come over to the delta column or any column and change it to display another field, such as probability in the money. For now, I'll just leave it on delta, which I know is a 43% probability of finishing in the money. Because I don't break even until this option actually trades 61.55, what I want to know is my probability to profit, which is the likelihood that this stock will not only trade above $61, but also cover the 55-cent premium I paid. I can just look at these other strike prices and make a guess at what my probability to profit is. I see the 6150 strike has a 0.31 delta, so I could probably guess it's pretty close to that. Fortunately, I don't have to guess. I can confirm this with the use of the Analyze tab. Here, all I have to do is right-click anywhere on the order bar and click Analyze Trade. This is going to load the trade into the Analyze tab, where we can further evaluate. If this is the first time you're seeing the Analyze tab, let me give you a quick walkthrough how the Analyze tab works. It's a graph that has stock prices on the x-axis and profit and loss figures on the y-axis, allowing us to see what our profit and loss on a trade is, based on where the stock is trading. We see two lines, a blue line, which represents this option profit and loss on expiration, and a pink line that represents the profit and loss at any parameters we set. Currently, the pink line is set to today's date, but if we wanted to, we could change that to get a better idea of how this position will look at any point in time. More on that later. For right now, let's concentrate on the blue line, which is our profit and loss at expiration. Notice the zero horizontal line. This is where we break even on the trade, which is currently set to 61.55. Anything above this point is profit, and anything below this point would be a loss. Here, we can see if the stock trades up, for example, to $66, we're going to have a profit of just over $4,000. If the stock was to expire below $61, no matter how far down it traded, our max loss would be capped at just $550. This is a pretty simple graph, and hopefully it makes a lot of sense. As we get to more advanced trades, these types of graphs are going to be very helpful in understanding exactly what's going on and what we want to happen. So, back to why we came to this graph in the first place, finding our probability of profit. First, we make sure that this box up here says ITM. Next, come down to the bottom and make sure only the strike we want to find pop on is checked. Now, come up to the top date and change this to the option expiration date. Don't confuse this date with the bottom date here, which is something different. This top date is what we care about. Because this option expires on June 2nd, we want to change this top date to also reflect June 2nd. Finally, click the menu box to the right of this plus button and select Set Slices, then Break Even, then the blue date. This will set our price slice right on our break-even date, which will then give us our probability of profit at the top right-hand side of our graph. In this example, we have almost a 31% chance of this trade being profitable. Therefore, we have a 69% chance of losing this trade, which is displayed on the left-hand side of the page. I don't know about you, but I don't want to make a trade where I have a 69% chance of losing. This is not a sustainable strategy. Option traders that do go after these types of trades typically burn out or think option trading just doesn't work. It does work. They were just implementing the wrong strategy. I hope this walkthrough was informative. In the next lesson, we're going to review everything we just learned, how buying options relates to puts, and what to do on an expiration Friday. All right? I will see you in the next lesson.